Today, we're plunging into the mysterious realm of taxes. Not just any taxes, mind you, but the elusive world of how the wealthy manage to keep their money hidden and pay the bare minimum in taxes. It's like discovering the secret sauce to financial freedom. Excited? You should be, because this journey is going to be a game changer. Hey, before we dive into today's content, make sure to hit that subscribe button and ring the notification bell so you never miss an update from our channel. Let's kick things off by introducing you to two characters in this grand tax saga: Paul, the willful taxpayer, and Jack, the tax avoider. Paul is your average Joe, seeing taxes as an unavoidable part of life. He earns $40,000, hands over 15% to the government, and carries on with his routine. On the flip side, there's Jack, a medium-sized business owner who's fed up with watching a significant chunk of his hard-earned money vanish into the tax abyss. So, what's Jack's grand strategy? He immerses himself in the intriguing world of corporate tax strategies. First up, the wizardry of writing off expenses. Picture this. You own a digital marketing agency making $200,000 a year. Legitimate business expenses, from office supplies to staff training, can be deducted from your income. Turn $200,000 into $100,000, and just like that, your tax bill is sliced in half. Jack realizes that most rich individuals amass their fortunes through businesses, providing them with a golden opportunity to whittle down their taxable income. It's a game of deduction, a dance of expenses against earnings, and only those who own businesses get to enjoy this spectacle. No wonder business owners seem to be considerably richer than regular employees. Jack, however, is not content with just writing off expenses. He's ready to play the global income game. He contemplates moving his business from the high-tax Silicon Valley to tax-free havens like Texas, Nevada, or Florida. The potential 13.3% tax saving on the state level alone makes it an enticing prospect. Sun-soaked tax benefits? It's starting to sound like a win-win. This strategy isn't just about moving a business. It's about strategically placing income where the tax rates are most favorable. Jack is keen on exploring jurisdictions that offer not just lower income tax rates, but also additional perks like banking privacy and fewer regulatory hassles. The game is on, and Jack is making his moves. But wait, there's more to Jack's playbook: real estate. Now, let's delve deeper into the fascinating world of real estate, Jack's secret weapon in the quest for wealth accumulation. Imagine real estate as the grand stage, where the rich choreograph their financial ballet, and Jack is about to join the dance. When Jack talks about making his money work for him through real estate, he's not just referring to the simple act of property ownership. No, it's a multifaceted strategy that involves leveraging the unique benefits that come with being a real estate mogul. Let's start with the basics. Jack realizes that owning property isn't just about having a place to call home or a storefront for his business. It's about turning that property into a financial powerhouse. The primary vehicle for this transformation is the concept of depreciation. You see, when you acquire a property, you're not just buying a physical structure. You're acquiring a depreciable asset. From an accounting standpoint, the value of that asset decreases over time. Now, here's where the magic happens. You get to deduct this depreciation from your taxable income, effectively reducing the portion that is subject to tax. It's like having a perpetual money-saving wand. Repairs to the property, mortgage interest payments, and a myriad of other deductible expenses become part of this financial wizardry. Jack realizes that every dollar spent on improving or maintaining his property is a dollar that won't be dancing with a taxman. But that's not the end of the story. It's just the opening act. Enter the pièce de résistance, the 1031 exchange. Picture this. Jack decides it's time to part ways with one of his properties. Instead of facing the usual tax implications of a property sale, Jack executes a financial pirouette known as the 1031 exchange. Here's the brilliance of it. Jack sells a property and, within a specific time frame, uses the proceeds to acquire a new one. And guess what? The tax on the sale is deferred. Yes, you heard it right. Deferred. It's not cancelled or erased, but it's pushed down the timeline, creating a perpetual cycle of property ownership and tax savings. Think of it as Jack having his financial cake and eating it too. He gets to upgrade or diversify his property portfolio without the immediate hit of capital gains tax. The cycle continues: acquire, appreciate, and exchange, all while keeping the taxman at bay. But wait, there's more to the real estate saga. Jack is also savvy to the fact that selling a fully depreciated property might trigger a significant tax event. However, he's got that covered too. By perpetually engaging in the 1031 exchange, Jack can keep deferring the tax impact, ensuring that his real estate empire remains a tax-efficient haven. It's like a strategic chess game where each move is carefully calculated to maximize wealth and minimize tax liabilities. Jack understands that real estate isn't just about physical structures. It's a dynamic financial instrument that, when played right, can become a perpetual generator of wealth. As Jack adds more properties to his portfolio to dance with depreciation, and the 1031 exchange becomes a symphony of financial success. It's not just about bricks and mortar. It's about creating a financial legacy that can withstand the test of time. But Jack isn't done yet. He's now exploring the art of income deferral with individual retirement accounts. Imagine contributing to your IRA and receiving a deduction from your taxable income. It's a powerful move, especially for high-income earners like Jack. The most common tax deferral vehicle, an IRA, allows you to move your income into a fund and subject your earnings to tax at a later date. If you're an employee, you likely use this type of account to hold your savings, allowing them to grow over time. However, Jack sees it as more than just a savings account. It's a solid tax avoidance strategy. Income earned from employment is typically subject to tax unless you contribute funds to your IRA. By doing so, you receive a deduction from your taxable income in the year you contribute. For someone earning $500,000 a year in the highest tax bracket, this can be a game changer. Instead of paying a 40% tax on the entire income, you can potentially reduce the tax portion to 20%. It's like a financial time machine. Pay less tax now and potentially pay even less in the future. And there you have it, a deep dive into the intricate world of how the wealthy navigate the tax maze. The choice is now yours. Remain a willful taxpayer like Paul, accepting taxes as an unavoidable part of life, or take a leaf out of Jack's playbook and become a savvy strategist. Taxes don't have to be a burden. They can be a puzzle waiting to be solved. Thanks for sticking with us through this enlightening journey into the secrets of the wealthy. We appreciate you being a part of Wealthway today. We're dedicated to helping you achieve financial success, and we hope you've gained valuable insights from this episode. If this video resonated with you, please give it a thumbs up and consider subscribing to stay in the loop for our upcoming content. If you have any questions or want to share your experiences, don't hesitate to leave a comment below. Until our next encounter, continue on your journey to financial prosperity. Because here at Wealthway, we're confident that your wealth is well within your reach.